This presentation is strictly for educational purposes only. I am not a SEBI-registered investment advisor. Markets involve risk. Please do your own research or consult a qualified advisor before making any trading or investment decisions. In this video, I am going to break down what really happened in the market during January, what February is starting to confirm, and why this phase should not be mistaken for a market top. This analysis is based purely on institutional behavior, not opinions or predictions. Welcome back to Learn Trading with Thirumurugan Rajendran. I don't predict. I prepare. I show how I read the market. January was clearly a distribution phase. Foreign institutional investors were net sellers across most trading sessions, with multiple days of selling in the range of 3 to 4,500 crore rupees. This selling pressure explains the volatility and repeated failure of upside moves. The most important part of January is not who sold. It's who absorbed the selling. Domestic institutional investors consistently stepped in, with several sessions showing 3 to 8,000 crore rupees of net buying. This absorption prevented a structural market breakdown. Absorption does not mean the market must immediately go up. Absorption simply means that downside is being protected. It's a process where supply moves from weak hands to strong hands. This is how durable market bases are formed. As we move into February, behavior starts to change. FII selling pressure reduces noticeably. On the 3rd of February, FIIs turned net buyers with over 5,000 crore rupees of inflows. Importantly, DIIs did not exit during this phase. This is what confirmation actually looks like. Sellers are exhausted after prolonged distribution, and buyers refuse to leave after absorbing supply. Price stabilization following this behavior is a textbook reaccumulation signal. Options data strongly supports this structure. Put net open interest has remained consistently positive, ranging roughly between 2.5 to 4.5 lakh contracts. This indicates aggressive downside defense by option writers, while call writing remains controlled, not panicked. This phase is not euphoric. It's not a blow-off top, and it's not a straight-line rally. Transitions are usually slow, volatile, and confusing, but structurally healthy. January was the distribution phase. Domestic institutions absorbed the selling. February has begun with confirmation. This is not a market top. This is a transition phase. In transition phases, discipline matters more than prediction. Focus on buying dips rather than chasing rallies. Avoid emotional shorts. Manage risk carefully. And let institutional behavior guide your decisions. If you want to understand markets through structure, flows, and data, not noise, subscribe to the channel. No predictions, only clarity. Thank you.